Well, good morning, traders. So certainly non-existent moves again coming through US markets. I don't think that's going to surprise anyone. The intraday ranges we've been seeing, those closing change percentage changes is non-existent at the moment. And if you look at implied volatility, which of course we see that through the VIX, traders are expressing a view that they just really don't see a move coming through in these markets in the next 30 days at all. And I think that seems, fair. There's a lot of structures which, of course, are suppressing volatility at the moment. But very, very calm conditions continue to come through. Now, of course, Apple, as we spoke about yesterday, has performed very well in the cash session. That stock's attracted a lot of institutional flow. After market, there's been a lot of activity from clients in Tesla. If you look at their gross margins in the auto sector, 120 basis points or so above the market's consensus. Their cash burn was probably slower than what people were looking for, and I think people will look at that second half capex guidance, significantly higher than where the market's going forward. So this remains that sort of call option on the disruptive force within the automo sector. Will they get it right? Will there be increased competition in this space? One suspects there will be going forward, but doubt the market has warmed to what we've been seeing from the numbers today, and the stock's at about 9% in the after hours. So there has been a lot of concern about the stock going forward. I mean, something like Goldman Sachs have got very, very bearish price targets on Tesla, but the stock's performing very well today, and it has been performing quite well over the last 2 weeks as well. So we've seen a lot of flow into that stock at the moment. Now, if you look at the rest of the sector, there's been a lot of focus on the Fed. There's been a lot of focus on various calls about the balance sheet and potentially normalising that and the levels they need to normalise that in October. The wash up of all that, and if you mix in the ADP private payrolls number, which came out about 178,000 jobs, was that you have seen the curve steepen a touch. The 10-year yield has moved up a couple of basis points, so no real move there as well, up at 227. The dollar has it's remained fairly unchanged on the session, which is a gain in itself, to be honest. But we are starting to see people warming a little bit to the US dollar, so definitely put that on the radar. Euro dollar looks like it may want to mean revert somewhat at the moment. If you look at the yield spread between US Treasuries and German bunds, that premium that the US Treasury market commands over German bunds has come in quite significantly recently. But I think even where it is now, it doesn't warrant a euro dollar coming in at that 118 level. So I think there is a possibility, and we watch price action, that we could see this coming down a couple of hundred points in the near term, just catching up with some of the fundamentals. But this is a dollar play and needs US dollar to strengthen, and of course that means we're going to need to see wage data this Friday and the non-farm payrolls looking a bit more healthy than what the market's looking for, about 2.4%. Have a look at that unemployment rate. The market's looking for that to be about 4.3%. So that really does suggest that the Phillips curve is suggestive longer term, and the Fed believe this, that we are going to see wage inflation coming through. It's a big if, of course. The Aussie dollar has firmly closed below that 79 handle. We're sort of trading in mid 79s. There is a firm belief now that we are going to see GDP being revised down by the RBA this week in their statement of monetary policy. I think they've given the game away by suggesting their growth rate over the next couple of years is going to be about 3%. Their models at the moment, their forecasts in the previous statement of monetary policy suggest that was going to be a bit higher. So we're looking for an aggregate GDP cut across a couple of years of about 50 to 75 basis points. That's probably priced in now, but I do think this is a time to look less positively on the Australian dollar. Specifically, we've been looking at Euro Australian dollar upside. I'd certainly be looking at waiting for a little bit of a pullback in this and probably be looking to buy the dip, because Euro Aussie is looking quite positive at the moment, quite bullish. I think this trade goes higher. In terms of the FX markets, the Swissie's been hit pretty badly. I still really like the Swiss franc as a longer term short. I see absolutely no reason to be owning this unless you do see a massive pickup in risk aversion coming through in markets. At the moment, it's the firm funding currency of choice, and I think sterling Swiss looks strong, Euro Swiss looks continually strong. I think this trades nicely into 115, 120 over a long period of time. Even Aussie Swiss, if you want to play the Aussie from the long side, you do it against the Swiss franc at the moment. Swiss franc is the most overvalued currency out there on a purchasing power parity basis, and this remains the currency which I like shorting the most going forward. In terms of the wash up for today, well, I think everyone's going to be focused on the open for Rio. It's down nearly 2.8% in the London listing. Obviously it has done more on the capital management, but it's obviously not enough to please a market which has probably priced in a lot of good news, and the net income numbers were clearly not as good as what people were looking for. Neither were the revenue numbers, just under 20 million. The market was looking for more there, and certainly, I still like the stock from a return on equity perspective. 24% in the mining space is fantastic, efficient use of capital, the shareholders' capital. But ultimately, this stock looks like it wants to go lower in the short term, and you've got iron ore spot prices down about 1.7%, which is clearly not going to help either. So we're looking for a bit of weakness in that stock. BHP probably, it's going to be interesting to see how that stock opens. We have seen oil prices moving a little bit higher, so that should be supportive of the stock. We've got WTI again looking to test that $50 mark. We saw a big drawdown as expected in the gasoline inventories in the Department of Energy number last night. The crude inventories did drop, and we saw a draw there, although it probably wasn't as much as what the market was looking for, and that has pushed the oil price back up into what looks like it could test the $50 mark again. So tough times to be in the energy space. It's a trading sector, and there's no real conviction from investors to hold positions in that. In terms of earnings today, aside from Rio and watching what happens there, you've got Downer and Suncorp and Seven West reporting, so it'll be interesting to see how those numbers are reporting. They will report early on, so let's see how the market takes those numbers. And we are expecting the market to open on a fairly flat note. 57.50 is our call at the moment, so probably just a little bit of a pop on open. So a positive day here, but no real conviction from investors to push this market around. It seems like in a very nice spot in terms of fair value for this market at the moment.